Today we're diving into a concept with a name that sounds like it's straight out of a sci-fi movie, the 14,605 universes theory. I know, it sounds a little out there, but trust me, it's an incredible way to answer one of the biggest questions in all of investing.
And here's that question. How on earth do you win a game when you have absolutely no idea what the future holds? I mean, every single investor on the planet faces this. The market could boom, it could bust, some new technology could pop up and change everything overnight, so what's the right move?
For years, the whole debate has pretty much come down to two main philosophies. On one side, you've got the picking winners camp, the active approach, trying to find that one needle in a haystack stock that's going to crush it. And on the other side, you have owning the market, the passive, chill strategy of just buying a tiny slice of everything with an index fund. It's the ultimate showdown, the high-risk, high-reward bet versus the slow and steady approach. So, which one is actually better? Well, to figure that out, we don't need a DeLorean. Instead, we're going to take a journey to those 14,605 universes to find the most probable, most reliable path to success.
14,605. Now, that is not a random number pulled out of a hat. It's the exact number of possible futures, every single potential boom, bust, and everything in between that was simulated to really put these investment strategies to the test.
So what is this theory, really? Well, think of it like a financial multiverse. A supercomputer took decades of real historical data and key economic drivers and used them to create thousands upon thousands of different realities. You've got futures with crazy high inflation, some with deep recessions, others with wild tech booms. Then it ran our two strategies, active picking and passive indexing, through every single one of those universes to see which one came out on top most often. It's like having a crystal ball that shows you not just one future, but nearly 15,000 of them. All right, so we've traveled through this financial multiverse, we've gathered all the data. So what did the experiment actually show us? Which strategy held up the best across all those different possible worlds?
Let's just cut to the chase. When you look across all those alternate futures, which strategy actually won? Was it the flashy stock picker or the steady, boring market owner?
The result? Wow, it wasn't even a competition. In a staggering 95% of all the simulated universes, the simple passive indexing strategy delivered the best results. Active stock picking, it only came out ahead in a measly 5% of scenarios. Just look at that chart.
And this is the key takeaway here. When you account for a massive range of what could happen, the simple strategy of just owning the market becomes the highest probability path to success. Not just sometimes, almost every time.
The whole thing can really be summed up with this one quote. The long-term odds are not in favor of the active stock picker. The data across the multiverse is clear. I mean, it doesn't get much more definitive than that, right? Especially when it's backed up by that much data.
Okay, so we know what happened in the simulation. The big question now is, why? Why does the simple, kind of boring strategy of indexing consistently beat the exciting hunt for the next big thing?
See, the simulation doesn't just give us a winner and a loser, it actually shines a light on a few core fundamental truths about investing that explain this lopsided result.
And it really just boils down to three simple, powerful advantages. First up, lower fees. Active funds cost more, period. That money for research and management eats away at your returns year after year. Second, wider diversification. When you won the whole market, you're not going to get wiped out if one big company or sector has a terrible year. Your risk is spread out. And third, and this one is huge, avoiding human error. Indexing is automatic. It takes away the temptation to sell everything in a panic when the market drops or to chase a hot stock when it's already at its peak. Those emotional mistakes that can just destroy a portfolio.
You can see it laid out right here. Active investing usually means high fees, really concentrated bets, and it's super vulnerable to emotional decisions. Passive indexing is the total opposite. Low fees, broad market diversification, and a systematic approach that just keeps our messy human emotions out of the equation. Over the long run, those small advantages compound into a giant performance gap.
So let's bring all this back from the multiverse to our one single reality. What does this all mean for you and your money? Let's talk about your most probable path.
So, what does a wild journey through over 14,000 alternate futures mean for your actual wallet? Right here, right now. Well, it means you can actually align what you do with the highest probability of success. The big takeaway here is actually pretty simple. Focus on the stuff you can actually control. Keep your fees low and stay diversified. Play the long game, because that's where all these advantages really start to shine. And finally,
Build your strategy around what's most likely to work out, not just what you hope will happen in a perfect world.
And that really leaves us with one last big question to think about. It's a question that honestly reframes this entire debate. Ask yourself, is your goal to have the thrill of trying to beat the market? Or is your real goal to simply and reliably reach your own financial goals? Because those 14,605 universes have given us a pretty darn clear clue as to which path is more likely to get you there.